Okay, I think I'm ready. How about you? Good morning. Welcome to Forex.Today, the YouTube community of more than 20,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades in advance, because trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results, but please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Ni hao ma! Hey, my name is Wayne. I'm a currency trader just like you. I'm super excited about what the ECB is going to do next. They are way behind. And they need to jack up interest rates. Yeah. Cool. Hey, but what about retail sales in the United States? Oh, yeah, that's coming up today, too. Hey, did you catch the news out of China last night? Hey, did you catch the news out of the Fed yesterday? Oy vey. And Bank of Japan next week. We got so much going on. Or wait, Bank of Japan this week, Bank of England next week. Just whoa. So much to do, so much to think about, so much to analyze and plan. But that's why we gather as a community, because it's impossible to do it on your own, but it's possible when you collaborate. I got that from some ad I heard this morning, but I'm like, you know what? That actually sounds pretty good. Right? It's only impossible if you try to do it on your own. So anyways, hey, thank you for being with me and making a community out of what we do. I did start trading Forex 20 years ago by myself, and holy smokes, like I said, I think it's impossible. So anyways, I think what we do as a community is good. I think we make the world a better place. So thank you for being such a positive influence and sharing all your positive energy every single day. I'm here to serve you, so let me know how I can help. So today I think we just watch the ECB, we pick up the retail sales, and I don't know, we lean back and let it happen. We'll experience it together, good or bad. Look, there's more resources in the description below. There's a 2-hour webinar on how to triple your trading results without changing anything on your charts. In fact, spending less time in front of your charts. And I explain you how to do it for free. Yeah, there's a sales pitch at the end, but the rest is legit. And if you ain't got no money, don't worry about it. I show you how to do it for free. There's a link to my book, Strategic and Tactical Forex Trading. It's pretty good. You should check it out. Leave a review on Amazon.com. There's a link to tradersway.com. They're an ethical foreign exchange broker. I recommend them. They've earned my loyalty and respect. If you try them, even on a demo account, maybe they'll earn yours. I also am the leader of a community called FX Bootcamp. I've been doing that for approximately 20 years. It's also pretty good, and it's awesome, in fact. $88 is your annual membership fee. You're like, Wayne, what do I get for that? Well, how about 88 hours of training videos on macroeconomics, the oil industry, swing trading, monetary policy, trader psychology, technical analysis, fundamental analysis. It's all there. How about hundreds and hundreds and hundreds of files for your MetaTrader platform, whether it's MT4 or MT5? Yeah. That's just some of the love and joy. Members met yesterday to do the FOMC live as a community. Dozens and dozens and dozens of people got together. It was awesome. Loved it. So check it out. A whopping $88 a year. It's cheaper than the YMCA. So anywho, lots of resources available to you. There's no need for you to do this on your own. In fact, it would be kind of silly for you to even try. Why? Why would you do that? So anyways, welcome to the world of Forex. Yep. Oh, let me get that out of the way. That's oil inventories, by the way. This is what the Wayne do. There we go. Okay. So it's about 8:08 and around 8:15 is the ECB. So let me get that teed up. Un momento, por favor. Muy bien. ECB. Oh, it was right there. How funny. ECB. Ba, 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 ba. So 26 minutes until the meeting, but I believe this comes out at 8:15, the actual number. So ECB EU. Cool. Okay. So anyways, lots of interesting things coming, happening. So we'll do that together. How exciting. Okay, so I guess we could take a little glimpse at the quant box. Do I have? I don't know where in the world do I have. Where in the world do I have a version of it? Hang on, that's from yesterday. No. I'll just open a new iteration. Un momento, por favor. Let me go to Quant Box. We'll take a look. Go to the dashboard. What was I going to do? Oh, yeah. Quant Box Pro. Log into the appropriate Gmail account. Going into the Google Cloud. Ba, 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 ba. Load in. Hey, it's a database. It's not a web page. Takes a while to do the calculations. All right. What did I want to do today? We can look at the euro. Okay. And let's do a zoomie. So there we are in the world today. You can see the trend is quite bullish-ish, right? Quite bullish-ish. But where is the euro right now? GDP growth. Negative. What? And yet they have 6.1% inflation. Okay. Look at the difference in interest rates, huh? So the United States raised interest rates to 5.25%. And the United States has 4% inflation. Europe is slow and they're way behind. And guess what? They have high inflation. So one might assume that they're going to be changing interest rates sometime soon, huh? 66% of institutional investors are long, long the dollar, but they're also long the euro. So that's why it's quite neutral in that sense. Okay, if we look at seasonality, there's a little up over the summer and then a little down a little bit later before a big rally up. So yeah, quite a few people or quite a few institutional investors are long the euro because of that idea that interest rates need to go up in Europe. Okay? But the danger today, is this shows what people were thinking about 10 days ago. It's not that quant box is lagging. This data comes out on a Tuesday. Okay? Last Tuesday. It's released on Friday. So we have the most update information, but based on what happened yesterday, you could assume, forget euro, but you could assume just here that this will rise a little bit. Okay, we'll lose some bears and we'll gain some bulls. And that could drag down the euro. Yeah? You see? So even if Europe raises, I think this one strengthens. So, But nonetheless, what we do know from that economic analysis is that the ECB is behind. It's pretty, huh? I know. Okay. We're already kind of coming in low, but notice what we see over the last 5 years and the last 20 years is that over the summer, this pair is flat. It'd be interesting if there could be a little up, and a little down, and a little up, and nothing really happens until about October. So we'll keep all that in mind. We'll see how the shift in the central banking policy changes things, if at all. All right, the actual headline news should be out right now. Does anybody have the number? Up 25. Yeah, here it is. Today is going to be the day that I'm going to be you. All right. Inflation has been coming down. Let's go back to it. Did I kill the quant box? Let's go back. And what they're saying here is inflation has been coming down. I have to go back full screen so you can see it. Okay, inflation has come down almost 1%. That's what they're saying. Okay, we know that. Inflation has been coming down, but is projected to remain too high for too long. The Governing Council is determined to ensure that inflation returns to 2%. Okay. Oh, in the medium term. Oh, great. That's good. It is therefore today decided to raise the 3 key ECB interest rates by 25 basis points. Yeah. The rate increase today reflects the Governing Council's updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of the monetary policy transmission. According to the June macroeconomic projections, Eurosystem staff expect headline inflation to average 5.4. Wait, what? And so you're like, well, what? 5.4, and it's currently 6.1 and was higher than that. And I can actually show you the history. I just haven't released the tool. But anyways, someday. So what they're saying here is they expect inflation to continue down quite a bit statistically, over the second half, because if we were, let's say, at 8 recently, and we're still, 6, and they think we're going to average over the year 5, that means we got to be 3.5 by the end of the year. What do you guys think? Are we going to be at 3.5 inflation? Not interest rates. Inflation in the next 6 months? Do you think inflation's going to drop 50% in Europe in the next 6 months? What's your thoughts? You know what? Let's do it this way. Let's do anonymous. Will inflation drop by 50% in the next 6 months? Question. Yes, no. I don't know. Okay, let's see. No way, Jose. I don't know what you're talking about. No way, man. I don't know. Well, it depends. It depends. Maybe oil goes to 0. It's possible. But is it likely? Richard says, but GDP is printing negative. Well, that's not necessarily inflation. That's growth. Doesn't talk about prices. Okay? Go to any emerging market, you might find low GDP and high inflation. Okay? Let's see what you guys think. Only half of you have voted. What, you got a broken finger? Half of you got a broken finger, huh? I can't click my mouse with a finger like this, Wayne. Really? For shame. For shame, you other 50%. All right, you lost your opportunity, lurkers. Okay, let's see what the strong half think. All right, 38 votes. That's statistically relevant. And the answer is no way, Jose. Okay, well, there's the issue that I think we need to look at, or what you can do in your research, is ask if inflation is down, so we'll call this little I is down, then what kind of little I is down? Question mark. Let me show you how to do this. Why? Because you're my sweet baby and I care for you. I'll show you. In the United States of America, the Fed says, hey, inflation's dropped from 10% to 5%. Yeah, okay, great. Cool. So let's start with what has fallen. Okay. Used car and truck prices have fallen to negative. They're actually negative. Oh, good. Thank you, Fed. What, the Fed did this, right? By raising interest rates, they made used car prices fall? No. That had to do with the supply chain normalizing, and suddenly you could get a new car. A year ago, you couldn't get a new car, so you were forced to buy a used car. So all that demand went to used cars. And there was increase in demand and not enough supply, bada bing, bada boom. Well, those prices are down now and has nothing to do with the Fed. Okay, then we look at energy. Energy came down. Okay, look at those big negative numbers. Oh, thank you, Fed. That was because the Fed raised interest rates by 5%, right? No, that was because the U.S. government emptied 50% of their strategic petroleum reserves, dumped oil onto the market, and drove up supply and drove down price. Oh, wait, so that had nothing to do with the Fed? No. Oh, okay, so none of that had anything to do with the Fed. Okay. Well, everything is still up. We still have high inflation in food. And we still have high inflation in shelter and transportation and medical and apparel. And you're like, well, golly gee whiz, Batman. Then we still have inflation everywhere, except for stuff that had nothing to do with the Fed. So can the Fed claim winner, chicken dinner? Can the Fed go to Sizzler tonight? No. So if inflation came down in Europe, you want to kind of look at the same kind of stuff and say, oh, did energy prices come down because of the competency of the ECB and their amazing policies? No way, dude. Right? So, great. So we'll see. Now, their energy prices are probably quite different, right? You have to look at the Eurozone energy prices. But nonetheless, this is why you want to look at core. The problem is core cuts out this nonsense over here, but ignores this. Well, that's still important. How many people here spend money on food on a regular basis? Yeah, all right. So you're like, well, then that matters. Huh? Matters. Yeah, almost every day if I'm lucky. And then what happens is you have to buy food. So as food prices go up, you start to make substitutions. My wife was shocked yesterday. We were at a restaurant and I ordered chicken. And she even asked me about it later, like, why did you do that? I'm like, yeah. What the hell is wrong with you? Chicken. Huh? Like, yeah. So anyways, this is what you should be doing, breaking down what the inflation is so you don't believe the lies of the government. Well, they're not lying, but anyways, we need a clear picture of reality, right? Very often the people on TV, the talking heads, have a generalized understanding of what's going on, but not a comprehensive understanding. It's my belief that you should watch Bloomberg and CNBC and other financial news outlets and listen to what they're talking about. What is the subject matter? What's the zeitgeist, the lexicon of the market? Because it shows sentiment and focus and fear and greed and FOMO and all these different things. But you have to then take everything with a grain of salt and assume that even though they manage $1 billion or more, they understand about 30% of what's actually going on. And it's shocking. I used to look up to people on TV and say, one day I want to be Illuminati like these people. Now I am Illuminati. Did you know that? I was welcomed into the Society of Educated Persons. I actually was given a lamp. I have a lamp. Harvard gave me a lamp. Veritas. Huh? The truth. I know the truth. I know the information. And it's terrible to know the truth because then you look, the people you used to look up to, you realize are like Not that great. So you have to always take the next step where somebody says, oh, well, things are improving. Interest rates have gone up. Inflation's gone down. I think we're going to go into a soft landing. I'm like, okay, I understand that logic. But then when you look at the data, you're like, well, the only thing that's working in the United States right now has nothing to do with the Fed. Oh, well, that's relevant, isn't it? Isn't that relevant? Like, right? Imagine the scenario, guys, that oil prices go up. Now, I'm not saying that's going to happen. In fact, like I was just showing you, well, right before our meeting, okay, I gathered this from that because this is what the Wayne do. And I'm looking at this like we have more than enough oil. Oil prices don't have to go up. So I'm not fear-mongering here. I track this on a regular basis. I know you think I'm a supermodel, but I actually have to work. See, supermodels don't have to work for a living, right? So anywho, yeah, I'm looking at that and I'm like, well, there's no real reason for oil prices to go up. Okay. Or down for that matter. Unless you believe recession is coming. Okay. But nonetheless, so I look at that and say, all right. See, remember when oil prices were 120 bucks? It was when we were down here in supply. So now we're here and I'm like, yeah, no reason for up or down. No big deal. Whatever. We're fine. We have enough. Things are cool. Okay, so great. That's happening now. That's real time. That was updated yesterday. That's why I'm looking at it today. So anyways, holy smokes. So yeah, the only thing working right now is nothing to do with the Fed. Now you might say, well, if you look at all items, 0.2, 0.1, 0.5, 0.4, 0.1, 0.4. Okay, and now it's only 4. And you're like, well, maybe that's an improvement compared to last year. Well, yeah, but there's also base effects. And we're getting rid of all the noise, the data noise that came from COVID. Okay? And I have to look at, you can't just look backwards. You have to see now. And there's an extreme difference. One of the extreme differences between the COVID period and one period and the current period is that, for me anyways, I've had lots and lots and lots and lots of crews on my property during COVID. I hired dozens and dozens and dozens of people to do different projects and stuff. It was my way to like pump money into the economy, and pump money I did because my prices were at least double, sometimes triple. And I'm talking about, I had a 60-ton excavator on my property. I had 2 giant industrial cranes, concrete workers, framers, roofers, painters, just, I don't know, hammer and nail guys, carpenters, I guess you would say, trim workers, like just an amazing amount, right? And so anyways, back during COVID, they had so much work that they were turning business away. Okay, so that's COVID. And then we're talking about base effect. Economic data now versus economic data then. That same crew right now has no work and they're begging for work. When I say no to a project, their response is, well, how much would you pay? And I'm like, I've already said no. And they're like, we'll do it for break even, you know? So that's kind of like, that's the extreme I'm worried about, that might be coming down the line. Okay? Supercuts closed down. Some restaurants closed down. Construction crews are, right? Got nothing to do. Why is it that they have nothing to do? Is it that there's poor marketing and stuff like that? Or is it literally people have decided not to renovate their home? So like that crew, for example, over the last 6 months has just worked for one client, and they renovated the person's entire house. Multiple bathrooms, kitchens, and all that kind of stuff. A complete home remodel. And now they come out of that project and there's nothing. Why? Is it because people were borrowing money and interest rates are high for HELOCs, home equity line of credit, for example? Or if you refied, you could take money out, but nobody refis when interest rates or when mortgage rates have doubled. So refinancing of mortgages are gone. It's not going to happen for years and years and years. The first people to get laid off are going to be mortgage brokers, right? John, yeah, John. Builds Taj Mahal, now eats chicken. Hey, man, the Indians know how to make chicken, though. Oh, my God. That was one of the best parts of visiting India is the food. Let's just put it that way. Oh, my God. But number one rule in India, never eat at the hotel. Okay. Greg says parts of California are already starting to decline. Yeah. So anyways, I'm just trying to show these stark contrasts. Like, we see the economic data now, and we're also trying to project the future. And so we're trying to look at more like high frequency data, which is stuff that's just not on the normal charts kind of stuff. Does the ECB detail CPI like this? Yes. In fact, again, what do the Wayne do? So it's, where do I have it on this? On this website. I have ECB up. I have FedWatch tool up. I have summary of economic projections up. I have oil data up. It's so funny if you could see, if you only could see what's going on. I had it. Did I kill it? Hang on. I don't think so. Maybe it's on QuantBox. No. Streamlabs. No. Snippy tool. No. Inbox. No. Where is it? Hang on. It should be here somewhere. I don't think I killed this page I'm looking for. I just got to find it. Is it not? Is it on the Streamlabs browser? See, the thing is I have too many browsers open, right? Not on that. Not on that. So I'll close these things. Hang on. I'll find it. It's not there. Is it under data? My data studio? Yeah. Okay, good. Found it. So I already have this open. Look this, right? So this isn't ECB. Okay, but I'm answering the question, right? Can you get breakdown detail on CPI? This is out of the UK, so I'm on the Office of National Statistics for the UK, and I was doing research on things like their unemployment rates. And this is where we are right now. Okay, so I know I'm not. Look, I'm not going to force feed it to you, right? So you have to do your own research. But I'm just trying to show you that this is out of the UK. Can you get breakdowns and stuff? Okay. And, well, yeah, you can do some research. See, it's not exactly the same, but yeah, you can. because you're my sweet baby, I will give you this. Compliments of the firm. Oh, no, it didn't do it as a link. Oh, yeah, no wonder. I'll give you this. If you can only see the way he does economics, maybe you would understand. Okay. So anywho, there's your table. Okay, maybe you want to do it in Excel, all that kind of stuff. Beautiful, right? If you could only see. Alcohol and tobacco in the UK up 9%. Look at that. Food up 20%, guys. Ooh la la. Oh, God. Restaurants and hotels up 10. Okay. Okay, that's owner equivalent rent. That's 4. In the United States, it's 8. It's 8? Yeah, you got to know these things. You got to know these things. Right here. 8. Huh? Shelter, owner equivalent rent. In the United States, or in the UK, it's only 4. Anyway, so you got to know these things. Here we go. There's the 4. So anyways, interesting, right? Goods and services, they still have lots of good inflation. So goods inflation, which means they're struggling on their imports and exports. Services are still red hot, but not nearly as bad. This in the United States, to compare and contrast, this number is fallen significantly, and this one is now rising. Because, like, if you look in the in the UK, transport is only 1.6, but again, compare and contrast that. Remember, QuantBox does all of this for you automatically, of course, but to compare and contrast, transportation is 10. So we have service inflation now, not goods inflation. And the UK still has high goods inflation. Okay? Richard's like, what about the breakdown of GDP? Yeah, well, that's the formula. C plus I plus G plus, and then you have to do parentheses, because it's not plus X minus M. It's plus X minus M. Not C plus G, right? Not C plus I plus C plus X minus M. Anyways. Anywho, what an exciting world we live in. Are you guys ready for the ECB? Yeah, ECB in about 2.5 minutes. Now's the time to go get your coffee. Let's go. Take us to the Degadar system, Commander Data. Engage. Morning, mate up. Make sure you got your mommy fuel. There was a time when Mario Draghi was doing a press conference, and a woman heckler got up from the audience and ran on stage, tried to tackle him. I mean, like, kudos, like, that's a heck of a jump, huh? Yeah, good for her. I mean, she spent all week making the shirt. No, Jean-Claude Trichet, Greg, in my opinion, was the best. He looked like a player, like you'd hang out with Trump and Epstein at a party. What is up, fellas? We're gonna make a killing. Look at these ladies. You're like, oh my God, this guy. All right, here we go.
Good afternoon and welcome to our press conference. I'm joined here on stage by President Lagarde and by Vice President de
He's so funny.
My name is Wolfgang Preußel. We are, as always, in a hybrid format, so I also welcome those who are following via video. When you have a question, please turn on your camera and the microphone so we can hear and see you.
Yeah.
I hand over the floor to President Lagarde, please.
Thank you very much, and good afternoon to all of you.
She's casual today, huh?
The President and
Just
I
love the blue
welcome
glasses.
you to our press
Love
conference. Inflation has been coming down, but is projected to remain too high for too long. We are determined to ensure that inflation returns to our 2% medium-term target in a timely manner. The Governing Council, therefore, today decided to raise the three key ECB interest rates by 25 basis points. The rate increase today reflects our updated assessment of the inflation outlook, the dynamics of underlying inflation, and the strength of monetary policy transmission. According to the June macroeconomic projections, Eurosystem staff expect headline inflation to average 5.4% in 2023.
Isn't it nice we've already read all of this?
And 2.2% in 2025. Indicators of underlying price pressures remain strong, although some showed tentative signs of softening. Staff have revised up their projections for inflation, excluding energy and food, especially for this year and next, owing to past upward surprises and the implications of the robust labour market for the speed of disinflation. They now see it reaching 5.1% in 2023, before it declines to 3% in 2024 and 2.3% in 2025. Staff have slightly lowered their economic growth projections for this year and next. They now expect the economy to grow by 0.9% in 2023, 1.5% in 2024, and 1.6% in 2025. At the same time, our past rate increases are being transmitted forcefully to financing conditions and are gradually having an impact across the economy. Borrowing costs have increased steeply, and growth in loans is slowing. Tighter financing conditions are a key reason why inflation is projected to decline further.
You can just tell these guys know how to party,
as they
huh?
are expected to increasingly dampen demand. Our future decisions will ensure that the key ECB interest rates will be brought to levels sufficiently restrictive to achieve a timely return of inflation to our 2% medium-term target, and will be kept at those levels for as long as necessary. We will continue to follow a data-dependent approach to determining the appropriate level and duration of restriction. In particular, our interest rate decisions will continue to be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation, and the strength of monetary policy transmission. The Governing Council confirms that it will discontinue the reinvestment under the Asset Purchase Programme as of July 2023. The decisions taken today are set out in a press release that is available on our website. And I will
Which
now
I've already
outline
downloaded.
in more detail how we see the economy and inflation developing, and will then explain our assessment of financial and monetary conditions. Looking at the economic activity, the euro area economy has stagnated in recent months. As in the fourth quarter of last year, it shrunk by 0.1% in the first quarter of 2023, amid a drop in private and public consumption. Economic growth is likely to remain weak in the short run, but strengthen in the course of the year as inflation comes down and supply disruptions continue to ease. Conditions in different sectors of the economy are uneven. Manufacturing continues to weaken, partly owing to lower global demand and tighter euro area financing conditions, while services remain resilient. The labour market remains a source of strength. Almost 1 million new jobs were added in the first quarter of the year, and the unemployment rate stood at its historical low of 6.5% in April. The average number of hours worked
Yeah, they
has
were
also
all
increased,
tourism-related
although
jobs,
it is
huh?
still somewhat below its pre-pandemic level. As the energy crisis fades, governments should roll back the related support measures promptly and in a concerted manner to avoid driving up medium-term inflationary pressures, which would call for a stronger monetary policy response. Fiscal policies should be designed to make our economy more productive and gradually bring down high public debt. Policies to enhance the euro area's supply capacity, especially in the energy sector, can also help reduce price pressures in the medium term. The reform of the EU's economic governance framework should be concluded soon. So looking at inflation now. Inflation fell further to 6.1% in May, according to Eurostat's flash estimate, from 7% in April. The decline was broad-based. Energy price inflation, which had risen in April, resumed its downward trend and was negative in May. Food price inflation fell again, but remained high.
Yeah, it's only
at
50% higher than it
12.5%.
used to be, but it's down.
Inflation, excluding energy and food, declined in May for the second month in a row to 5.3% from 5.6% in April. Goods inflation decreased further to 5.8% from 6.2% in April. Services inflation fell for the first time in several months from 5.2% to 5%. Indicators of underlying price pressures remain strong, although some show tentative signs of softening. Past increases in energy costs are still pushing up prices across the economy. Pent-up demand from the reopening of the economy also continues to drive up inflation, especially in services. Wage pressures, while partly reflecting one-off payments, are becoming an increasingly important source of inflation. Compensation per employee rose by 5.2% in the first quarter of the year, and negotiated wages by 4.3%. Moreover, firms in some sectors have been able to keep profits relatively high, especially where demand has outstripped supply. Although most measures of longer-term inflation expectations currently stand at around 2%, some indicators remain elevated and need to be monitored closely. Turning to our risk assessment now. The outlook for economic growth and inflation remains highly uncertain. Downside risks to growth include Russia's unjustified war against Ukraine and an increase in broader geopolitical tensions, which could fragment global trade and thus weigh on the euro area economy. Growth could also be slower if the effects of monetary policy are more forceful than projected. Renewed financial market tensions could lead to even tighter financing conditions than anticipated and weaken confidence. Also, weaker growth in the world economy could further dampen economic activity in the euro area. However, growth could be higher than projected if the strong labor market and receding uncertainty mean that people and businesses become more confident and spend more. Upside risks to inflation include potential renewed upward pressures on the cost of energy and food, also related to Russia's war against Ukraine. A lasting rise in inflation expectations above our target or higher than anticipated increases in wages or profit margins could also drive inflation higher, including over the medium term. Recent wage agreements in a number of countries have added to the upside risk to inflation. By contrast, renewed financial market tensions could bring inflation down faster than projected. Weaker demand, for example, due to a stronger transmission of monetary policy, would also lead to lower price pressures, especially over the medium term. Moreover, inflation would come down faster if declining energy prices and lower food price increases were to pass through to other goods and services more quickly than currently anticipated. Let's look at the financial and monetary conditions now. Our monetary policy tightening continues to be reflected in risk-free interest rates and broader financing conditions. Funding conditions are tighter for banks and credit is becoming more expensive for firms and households. In April, lending rates reached their highest level in more than a decade, standing at 4.4% for business loans and 3.4% for mortgages. These higher borrowing rates, together with tighter credit supply conditions and lower loan demand,
Those higher borrowing
have
rates.
further weakened credit dynamics. The annual growth of loans to firms declined again in April to 4.6%.
Yeah, Milos points out that Powell didn't mention the
have
Ukraine
been
at
negative
all.
on average since November.
I suggested that most Americans have
Loans
forgotten
to
about it.
households grew at an annual rate of 2.5% in April and increased only marginally month on month.
They're more interested in going on vacation
Weak
and
bank
not
lending
drinking Bud
and the
Light.
reduction in the Eurosystem balance sheet led to a continued decline in annual broad money growth to 1.9% in April. Month-on-month changes in broad money have been negative since December. In line with our monetary policy strategy, the Governing Council thoroughly assessed the links between monetary policy and financial stability.
Right,
Financial
Richard.
stability
Makes sense.
outlook has remained
For sure.
challenging since our last review in December 22. Tighter financing conditions are raising banks' funding costs and the credit risk of outstanding loans. Together with the recent tensions in the US banking system, these factors could give rise to systemic stress and depress economic
Yeah,
growth
Maida,
in
but
the
it
short
probably
term.
is a good investment. If you can get
Another factor weighing on the
give
resilience
Ukrainians
of the
the
financial
weapons
sector is a downturn in the real
to
estate
knock out a
markets,
bunch of Russian
which could be amplified
weapons,
by higher borrowing costs
that's
and a rise
great.
in unemployment. At the same time, euro
You don't
area
risk any
banks
American
have
lives and you take
strong
out a bunch of
capital
MiGs.
and
Great.
liquidity positions,
Awesome.
which mitigate these financial stability risks. Macroprudential policy remains the first line of defense against the buildup of financial vulnerabilities. So in conclusion,
I think the
inflation has
American
been
military would
coming
want to
down,
do that all day,
but
every
is
day.
projected to remain too high for too long. The Governing Council, therefore, today decided to raise the three key ECB interest rates by 25 basis points in view of our determination to ensure that
Richard, that's
inflation
actually
returns to our 2% medium-term
not
target
true.
in a
I know it's
timely
said
manner.
all the time, but it's not true.
Our future decisions
Wars are
will
very
ensure
unproductive.
that the key
The
ECB interest
secret
rates
to wealth
will be brought to levels
wealth
sufficiently
creation
restrictive
is
to
productivity.
achieve a timely
War is one
return
of the most
inflation to our 2%
destructive
medium-term
things
target,
humans have
and
ever
will be
done.
kept at
So
those
it's
levels
terrible for growth.
for as long as necessary. We will continue to follow a data-dependent approach to determining the appropriate level and duration of restrictions.
No, it's true.
In particular, our interest rate decisions will continue to be based on our assessment of the inflation outlook in light of the incoming economic and financial data, the dynamics of underlying inflation,
Every war
and the strength of monetary
ever
policy transmission.
engaged by humanity
In any
has
case, we
created
stand
inflation
ready
and
to adjust
destruction.
all of our
That's not
instruments
good.
within our mandate to ensure that inflation returns to our medium-term target and to preserve the smooth functioning of monetary policy transmission. And we are now ready to take your questions. Thank you.
All right, here we
Thank you,
go.
President Lagarde. And the first question
Pay
goes
attention,
to
ladies and
Alex
germs.
Forani of Reuters. Alex, please.
Good afternoon, President Lagarde.
Good afternoon.
6 weeks ago, you provided a fairly similar guidance in your statement, and in the press conference, you said there's more ground to cover and the ECB is not pausing. So my first question is that if you have a similar guidance, are you willing to make the same comment in the press conference today? The second is, I wanted to ask you, what lessons do you draw from the Fed's pause? And I don't mean that you need to emulate the Fed. Clearly, the ECB has its own policy, but I mean the reasons behind the pause, as in quite a lot has been done, and there needs to be an evaluation of the effects of policy tightening. So do you see a reason for the ECB to contemplate a similar pause? And is there a risk that focusing on past projections?
Yes, that's what I was saying.
Could cause,
It's a
could
pretty
increase
good
the risk of
strategy
a
for
policy error by
Americans.
the ECB?
Yeah.
Thank you very much for your two questions, as I understand. So on your first question, this meeting was the meeting of a Eurosystem projection exercise. So we have looked very much at data. We have revised our projection, and we have essentially did what we said we would do. Data dependent, and using the three elements of our reaction function to determine what was the right decision today. And that is the reason why we increased all three rates by 25 basis points.
I'm going to switch this to Euro Yen.
Are we done? Have we finished the journey? No. We're not at destination. Do we still have ground to cover? Yes, we have ground to cover. And I can even go further than that. I can tell you that bearing a material change to our baseline,
So we got to watch 53 even,
it is very
I guess.
likely the case that we will continue to increase rates in July, which probably doesn't come as a big surprise to you, but that's what I'm telling you. And this is so because we are determined to reach our target in a timely manner and to continue to apply the principles that we have applied today. Data dependency, the three elements of the reaction function, and moving meeting by meeting. Now, obviously, we are better informed at each projection meeting, which happens, as you know, in June, in September, and later. To your second question, I don't know what difference to make between a pause and a skip, and I have not studied enough the press conference of my friend and colleague, Mr. Powell. But as far as the ECB is concerned, I said what I said. We have hiked interest rates. Unless there was a material change to our baseline, we will continue to hike at our next meeting. So we are not thinking about pausing, as you can tell. Thank you.
Thank you, Madame Lagarde. And the next question goes to Annette Weisbach of CNBC. Annette, please.
Thank you very much. I have two questions. One, I'm here for, it's different this time. I would like to ask you about what do you need to see for core inflation actually coming down, so it may give you the possibility to pause or to skip or to whatever you want to call it in September over the summer period.
I mean, you got to
So
give
what
the
needs to
British
happen?
some
And
credit
then
here.
I have a question.
Isn't it
on
amazing?
the financial
We're sitting
conditions.
here
You're
listening
saying
to
that they
a bunch of
are
Europeans
forcefully
all
tighter.
speak a language that is
so
not
at
native to them.
What would you make rethink that it's enough when it
Germans
comes to
asking a
tight
French
financial
person in
conditions?
English,
Thank
you know, so on and so forth. You're like,
Well, thank you very much for your question. I wish I could give you
Historically,
a
it's
very
actually
simple
pretty
answer
cool.
where I say when we are there and when
Well done,
financing
England.
conditions is such and the tightening has reached that level for corporate, for mortgages, but unfortunately it doesn't work like that, because what we know is the target that we have, which is price stability as defined by the 2% medium term, added to which we want to be confident that it stays at that target of 2%, which is why duration matters as well. But it is going to be a factor of those three elements that we will be looking at. So it's the inflation outlook, which is every month and every 3 months in particular, informed by all the new financial and economic data that we receive. It's the underlying inflation and the dynamics of it, and I can assure you that we look at multiple cuts and subset of inflation to arrive at what is the corest of the core, because we don't limit our review at core. We go further than that.
super core in the U.S.
Strip, super strip, PCCI. I mean, there's a whole variety of the prices and the inflation that we look at. And we need to see that we need to be confident that it is heading down. For the moment, we have some of those measurements declining a bit, some of those sort of stable, and others still going strongly. And the third component is the strength of transmission, which we measure at each and every step of the way, from the market rates, bond prices, credit by banks, banking funding, and then to the economy, which is how we refer to the 4.4 and 3.4 loans to corporate and households, because that's how it is transmitted, and ultimately to inflation. So that's the path that we want to see delivering, so that we head towards our target. That's what we have done. That's what we will do, and we will stick to that methodology. Thank you.
Thank you. Thank you very much. Next question to Alexander Weber of Bloomberg News. Alexander, please.
Good afternoon. Thanks very much.
Good afternoon.
I was wondering, how alarmed are you about the upward revision to the 2025 inflation outlook? And doesn't it mean that the 3.75% terminal rate that was generally expected, at least until recently, isn't going to be enough? And then secondly, you've alluded to the strength of the labor market and the impact that wages are having on inflation. Do you think you can achieve the 2% inflation target with unemployment remaining as low as it is now, or does it have to go up?
So your first question referred to the core inflation revision that we have decided for 2024. That's what you referred to? Yeah. Sorry, 25. Well, I think we revised actually all three. We revised 23 and 24, and ultimately the 2.3, which moved by 0.1 from the previous projections. I think on the basis of that, you can easily conclude that we're not satisfied with the result of that inflation outlook, which is only one of the three components that we look at. And that is the reason why we are making the monetary policy decision that we make today, and why we are thinking that unless there was a material change to the baseline, we would again hike interest rates in July. I don't want to comment about the terminal rate. This is what markets are considering. The terminal rate is something that we will know when we get there, because it is not what is driving our analysis and our deliberations. What is driving it is the ultimate destination, which is the 2% inflation. That's what we want. And there are lots of components that come in to help us arrive.
So I know I'm doing research on the dollar here, but looking at the last...
We spent a lot of time on the labor market.
No,
we spent a lot of time because it is becoming one of the major components of the drivers of inflation.
21
it was
to
energy
22.
for a long
Sorry, I
time.
read that wrong.
To sort of
I'll do this
oversimplify,
later.
energy
I'm
played
calculating
a significant
GDP.
role. Then food kicked in, and energy is now fading, has moved now in May in slightly negative territory. But labor and wages in particular is playing a significant role as a driver of inflation. And it's quite extraordinary because there have been more people employed. The average hours have been up. Wages are increasing. We had 5.2% for the first quarter in the negotiated wages. And the output is where it is, stagnant. So there is an issue of unit labor cost, in other words, productivity, which clearly has an impact on inflation as well. So we will continue to really monitor and dissect as well as we can this entire enigma of the labor market, which is, as I said, playing a critical role. And it's especially important because it is many services which are playing a large part in our economy are labor intensive, and wages in that respect play a key role. That is partly by the way, the reason why we have, I was going to say upgraded, but it's not upgraded, but we have increased our projection for core inflation in both 23 and 24.
Thank you, Madame Lagarde. And the next question goes to Jan Merlin of Handelsblatt. Jan, please.
Thank you. Good afternoon, Madame Lagarde.
Good afternoon.
My first question, I was a bit surprised by how strong this revision of the core inflation projection was. Could you elaborate a bit on the reason? Is that all due to wages, wage expectations, or are there other reasons behind that? Yeah, and my second question is about the decision today. Was it unanimous? Could you maybe give us a bit of a flavor about the discussion? Thank you.
Sure. On the first one, our revision to core inflation, I've started answering already in the previous question. A lot of it is attributable to the unit labor cost. That's a large chunk of the revision. The rest is what you have in the monetary policy statement, which is past upward surprises. So it's a different starting point, which is informed by data that came in after the last projection that we made in March. The latest data that we had in terms of inflation was from January. Now, things obviously changed between those January data and the May data that we have incorporated, because we cut off at the 23rd of May. So I think that's a small part of it. The large part of it is the unit labor cost.
Oh, Richard,
And you asked me
that's
about
imports
the,
minus exports. It's
you asked me about
import-export data.
The decision and the atmosphere. I have to tell you that it was
Came out
quite
today,
a harmonious discussion.
a few minutes ago.
And
Let me give it to you.
very good and thorough economic discussions. As I said, we went really deep into the analysis of the labor market and tried to really understand the forces behind inflation to better fight it. And it was a very, very broad consensus.
Thank you. Next question goes to...
And by the way, I just want to remind that it was a twofold decision. It was, number one, the 25 basis points, but it was also the decision or the confirmation that we would stop any reinvestment under the APP.
And now Aude Kerselek of BFM Business. Aude, please.
Thank you for taking my questions. What does the ECB knows about lag effects? What takes longer to transmit into the economy? What are you looking at more closely? And second question about your targets. According to projections, you do not expect to reach the inflation target in the next 3 years. Some economists suggest that this target is no longer valid, that 3% will be the new 2%. What do you have to say about that?
We have a target. We have agreed on the target. We are in the middle of that fight against inflation. And this is what we know. We're going to get to that 2% and we're going to reduce it to 2%. What happens next is another story. But we want to be at target and we want to be confident that it remains at target.
That's right. If it's a positive integer, that favors the US dollar. If it's a negative integer, it does not favor the US dollar. You have to look at it as cash in, cash out. Exports are cash in, imports are cash out. It's the flow of capital that we track as currency traders.
That we have made in the last soon to be a year, which are monumental by all accounts, both in terms of speed, in terms of height, volume of hikes, if you will, and we are seeing some effects. We are seeing it in market rates, we are seeing it in banking financing, we're seeing it in credit, both in volumes and in rates. And there is some lag time. Not that much by sort of textbook standards.
So think of it this way.
Typically say that it's anywhere between 18 and 24 months, maybe a bit more. But because it is so unprecedented and such
is spending
exceptional
by consumers.
situation, we really have to monitor that very
I
carefully. And
is spending
whether
by
it is going to be
businesses.
faster, whether it is going to be
G
a bit more
is
more
spending
slow
by the
because
government.
there has been variation in the terms of loans, for instance.
X minus M
to both
is
corporate
spending
and
by
mortgages,
foreigners.
and therefore the transmission is not
And that
operating as
equals
smoothly as it would
the total
if everything
economy.
was at floating rates. All of that we are looking at extremely carefully to measure the
So we're just
transmission
figuring
and
out
see
cash
how
in,
fast
cash
it
out.
moves. But suffice to say that we are seeing it already. Do we see all of it? Obviously, no. We want to see it all the way down to inflation.
Is that helpful?
Thanks. Next question to Martin Arnold of the Financial Times. Martin, please.
Hello, Madame Lagarde.
Hello,
Two
Martin.
questions from me. Firstly, the Bank of Canada recently restarted its rate hikes, saying that the reason for this was it thought the neutral rate had risen from its previous expectations. Do you think similarly, and is that part of the reason that you're continuing to raise rates and signal more rate rises are ahead? The second question is about whether the ECB could consider skipping rate rises, certain meetings, perhaps going to only changing policy when you're issuing forecasts, similarly to the Fed's pause or skip yesterday. Thank you.
But thank you very much for your two questions. It's difficult to say whether we're in the same position as the Bank of Canada because we did not pause. So in a way, we don't have to ask ourselves whether we are at neutral rate or not. We believe that we have ground to cover, so we are not where we want to be if we want to reach our target. And in terms of having to pause or having to skip, as I said, number one, we have not discussed it at all, and we have not begun thinking about it because we have
That's a
work
lot
to
of
do.
rate hikes coming.
Thank you. Thank you, Madame Lagarde. And the next question goes to Isabella Bufacchi of Il Sole 24 Ore. Isabella, please.
Good afternoon, and thank you for the opportunity. I have two questions. The first question is, today you repeated that rates will be kept at restricted levels for as long as necessary. And because inflation will be above 2% in 2025, we can expect restrictive rates for long. So how is the Governing Council concerned that you're going far and you at the same time would like to avoid unnecessarily harming economic activity? How far do you look at growth weakening in response to your policies? And then a second question is on this June, that is an historical month for the ECB. The 477 billion repayment of TLTRO is seen as the biggest daily reduction of the ECB balance sheet. And on the top, this June is also the last month of APP reinvestments. So what is the impact of these two unprecedented events, let's say in the ECB, on the impact on tightening of financing and monetary conditions? Thank you.
Thank you very much. I thought you were going to say that it's an important month because we are celebrating our 25th anniversary, which was also the date when the ECB was opened first on the ground here in Frankfurt. So, as I said, the objective that we have is very clear. The destination, we know. The journey to get there is not over, and we have ground to cover. So, we will be as restrictive as long as needed in order to make sure that we reach that destination. Under the current parameters, 2.2% in 2025 is not satisfactory, and it's not timely, which is why we're making the decisions that we are making today and later on. So on the At the end of June and in the first days of July, banks will reimburse 477 billion euros that they had borrowed under TLTRO, which was this very special facility that we had put in place to help the financing of the economy at the time of the pandemic. Those loans were granted for periods of 3 years.
Just a reminder to everybody,
in the course of the pandemic.
Today is the Swing
repayment,
Trading
which
Group
is
meeting
coming
at
due
4
now,
p.m.
is known and has been known for a long time.
This
Actually,
is
it
where
was
we
so
plan
well known
out
that it
next
should have been a
week's
lot higher than
trades.
that, but we took measures in order to avoid that we had this sort of cliff effect of a massive reimbursement, which would have exceeded 1 trillion euros. But banks know about it, they have known about it, they have done their funding plans in order to respond to the situation. And in any event, we have the normal facilities available, whether it's MRO or LTRO, if that was ever needed, just in case. The APP reinvestment will be completed at the end of June, and we will let runoff take place as of July. We have experienced that sort of partial reinvestment for now a few months, because it was decided back in March. It has been well absorbed by markets. We have not observed any disruption. And given the amounts that we are talking about, we have reasons to believe that it should be absorbed also in a smooth manner. But of course, we will be very attentive. We will look at this process, and we will, as I said, always have the means to take action and to use all the tools that we have available if it was needed. Thank you.
Thank you. And the next question goes to Klaus Raneakis of ARD Television. Klaus Rane, please.
I won't stop you if you want to sell it.
Thank you very much. Good afternoon. Mrs. President, you've touched on the problem of the wage increases. At your speech at the European Parliament, you touched on the problem of corporate profits. If you take these both together, how confident are you that the relevant parties actually start to moderate on this, in particular as both of them start to criticize that interest rates are already too high? And the second question, I'm also a bit puzzled about the really severity and persistency of this core inflation. May I ask you as well, please, to elaborate a little bit more where the Governing Council sees the reason for this really strong persistence? Thank you very much.
Yeah, thank you very much.
Is that how we move to the top of these ranges, huh?
The labor market situation and the employment situation is the good news in Europe. And we have never seen an unemployment rate be so low. Actually, in our forecast, we see unemployment rate go from this 6.5% that we have now to 6.3%. So we see that level of unemployment continuing to decline. We also see wages continuing to increase in the future. Now, you really asked me specifically the question of whether corporate and labor, and I'm using that term in a generic, comprehensive way, will find the terms under which they don't contribute to fueling even more inflation that would call on us to take harder monetary policy measures. This is the assumption that we make. I think economically it is justifiable, it is rational, but of course humans are humans, and it's going to be for the parties around the table to actually determine what they do going forward in terms of allocating profits and organizing these social relationships. What they can be certain of in their discussion is that the European Central Bank will take all necessary measures to return inflation to 2%. That they can count on. And we are confident that we will get there. So I hope it helps in their deliberation.
Well, we know the UK and Europe have to jack up interest rates big time. We know that to be
as I said,
self-evident.
has a lot to do with this unit labor cost that I have mentioned earlier on. And this is really the strong, I don't want to use sticky component because it is going to be persistent and we know it. And numbers will continue to be high in the months to come, by the way, because we believe that services are going to continue to go strongly.
Yeah, there's the trade
labor-intensive
plan from
services
yesterday.
Contact-intensive services will continue to go strongly. We're heading into the summer. All the summer activities, whether it's transportation, whether it's hospitality, whether it's vacation, all of that is going to go well. So that persistence is to be expected in the short run. And there will be remaining persistency going through into 24. It declines in 25. And we have not revised upward significantly for 25 because we believe that other elements will kick in, which will reduce inflation numbers. It's and unless risks were to materialize, but under the baseline, energy costs are going to continue.
So it's very basic training.
The cost of the indirect effect.
This is straight out of the FX Bootcamp training
course.
course.
Fade. You can still find them in prices, but it is going to gradually fade out. The same goes for food. And we expect that resistance of inflation to
look, even the
gradually
profit
fade
targets
away.
are hitting.
And
Check
as much
this out.
as it persists, we will persist.
Thank you. And the next question goes to Andres Stumpf of Expansion. Andres, please.
Good afternoon, Madame Lagarde. You have delivered quite a strong message about wages, and I'm a little bit scared. Has the risk of an inflation spiral increased since March? And second question about the projections. If 2025 is not acceptable, do we need to see 2% inflation in 2024 to the ECB to consider that the objective will be achieved in a timely manner? Or what is exactly a timely manner? Thank you.
Well, first of all, on wages, we are not seeing second round effect. We're not seeing this wage price spiral. The only thing that I'm trying to say here is that we have to avoid what I have called the tit for tat, where in response to inflation, both corporates and labor want to receive full compensation, which obviously would possibly lead to that second round effect that I was alluding to. Obviously, the sooner the better in terms of when do we bring inflation back to 2%. But we have to be also realistic, and we have to be measured in the response that we give, but very determined in the delivery of those measures, and persistent.
Thank you. And the next question goes to Jean-Philippe Lacour of AFP via WebEx. So Jean-Philippe, please turn on your camera and your microphone. We cannot hear you, Jean-Philippe.
Yeah, don't vet these guys first, huh?
Thank you for giving me the opportunity, but I'm afraid that my question was already asked. It was on this wages, and if you see a wage price spiral, the ECB wants to avoid. You said not, but it's a bit a thin difference. You said the wages.
How funny, huh?
Having
You're a reporter. You're an
on one
analyst,
side,
and
what
you have
say,
one
on the
question.
other side, you say that there is no kind of wage.
I do
price
not have no
spiral,
other
so it's not
question.
really
I am
clear to
sorry.
understand. Can you maybe give us an explanation on?
I
how
cannot
you
think about
can
anything
come to
else. I
this,
do not
conclusion?
know. Someone
Just
else
thought
wrote
we
my
said everything was
question.
clear and simple, wouldn't we? What I said,
Gee whiz.
and thank you very much for your question. What I said is that unit labor cost, which is slightly different than wages, negotiated wages, however you want to measure it, but unit labor cost is having an impact, or is rather causing the revision of core inflation projection. That's what I'm saying. And you can certainly have that projection, and at the same time acknowledge that today we are not seeing any spiraling of
No, I'm just
wages
saying you
and
should have more
prices
than one
that would
question,
cause
right?
the second
Revelations?
round effect that we would be very concerned
Like
about.
literally, if this was your job,
Thank you.
wouldn't you
Now
just
to
have a
Javier
lot of
Luengo
questions?
Of Negocios TV. Over to you, please, Javier.
You're like, I don't know, somebody else wrote my question for me. I have
Hi, can
no
you hear
idea
me?
what I could possibly ask you. Really?
Okay, thank you for taking my question.
I'm
You said that the
stumped.
financial markets are not feeling the impact of the balance sheet reduction. Do you expect to be able to increase it on July onwards? And do you think you have room to reduce it?
You know what? I'm going to ask you a favor. If you could repeat your question. The only thing I heard was something that actually I didn't say, but you said I said, which was financial markets will not react to the end
balance
of
sheet
APP.
reduction.
Yeah, but then,
Yeah, I don't know if do you think that you have room to reduce it further?
to reduce it further?
Further, yeah.
Well, you know, we two things. One is the TLTRO reimbursement that is falling due at the end of June, which was anticipated, known by all parties involved, is taking place at the end of June and in early
No, I know
July.
you only
It
get
will,
one
as a
question, but
result,
you should have a
reduce the
list.
balance sheet
I
of
mean,
the
just
ECB
it's
by
your job.
477
You should have
billion euros.
1,000 questions you want to
The
ask
second
the
part of the decision that we
ECB.
made today was to stop reinvesting
You should be able to sit with
reductions
Lagarde for
under
hours and
APP.
ask questions.
And let APP move into a runoff mode. That's all we decided. And that means that, for instance, the PEP continues as was indicated in the only part of forward guidance that we still have in our monetary policy, which is until 2024. We continue the reinvestment and we apply flexibility if and where it is needed. There's no plan to change that.
Thank you very much. That concludes our press conference today. Thank you very much for following. Our next press conference is on 27 July, and up until then, all the best. Thank you. Bye-bye.
What? That's the day after the Fed meeting. Again. So, hey, you got that on your calendar? 26th to 27th of July. Yeah, we're going to have interest rate hikes by the Fed and by the ECB. Ooh la la. Well, the thing is, we already know about the ECB, so that should bring in some euro strength. Excuse me. But what we did not know was the Fed going to raise a couple more times. So we got to get all that priced in. And right now we have new information coming in and out and all that kind of stuff. We have Bank of Japan. We have Bank of England. There's more stuff coming. So look, not a lot learned here today, but the ECB clearly is not even thinking about pausing. They haven't even talked about thinking about pausing. So they will continue raising interest rates. And so we already knew that, and she reaffirmed that. All right, cool, neat. But we have, you know, how you say, I think what we need to do is allow some seasonality to kick in. There's sort of volatility right now. I think focus more on the dollar. And so dollar was strong and then it was weak again. And then I think it may come around. Maida said, I swear I heard Powell say 2 to 3, even 4. Now he said 2. Well, I don't have it in front of me anymore. Well, actually I do have it in front of me. Do I? Where is it? Yeah, hang on. Let me bring up the summary of economic projections. Okay. 1 hike, 2 hikes, 3 hikes, 4. So when you average it out, okay, 2 hikes minus 4 plus 3 basically just gets you back to 2 hikes. So it is 1, 2, 3, or 4 hikes are possible. These are the votes or the opinions of each individual member, but you average it out, Maida, and there's 2. Oh, well, yeah, right. Well, he said, he's telling you what the dot plot said. But yeah, so anyway, so you guesstimate it all out. But nonetheless, yeah, it's interesting. We have seasonality coming that could impact some of this stuff. We also have import-export data, which wasn't great. And so you see the dollar weak now. That might not be money flowing into euro. But here's the thing. 40% of the entire Forex market is this currency pair that we're looking at. So if euro is attracting a bid right now on the idea that there's unlimited amounts of interest rates coming as they play catch up, well, then that might just weaken the dollar. Typically, it's the other way around. The tail wags, the dog wags the tail, but in this case, the tail's wagging the dog. Fine, cool, right on. So pick your lines, plan your strategies, do your analysis. Okay, use your quant box, use your technical analysis skills that you learned at FX Bootcamp. Be patient, be disciplined, be informed. Okay, and you'll do just fine on the long run. With that being said, have a wonderful trading day. If you're a member of FX Bootcamp's swing trading group or day trading group, we are all meeting today to plan out all of next week. It's my favorite day of the week, Thursday swing trading. So I'll see you at 4 p.m. on New York time. That's the close of the New York trading session. Looking forward to it. I will see you then, and thank you for hanging with me during this ECB event. Peace on earth. May the pips be with you. May your profits